While the Nasdaq was losing 78% of its value, while $5 trillion of wealth was being erased in what amounted to roughly 30 months, a small electric utility company called Southern Company was quietly returning 132% to anyone who held it. Not in a different decade. The same years, the same headlines, the same fear. That is not an anomaly. It is a pattern. And it repeats across every major crash in the recorded history of markets. But there is something strange about it, something that most financial education never explains, and that most investors never ask. Because if certain assets rise during every crash, why doesn't everyone simply own them? Why does panic spread uniformly across portfolios that should, by this logic, contain at least some things that are growing? The answer is not about the assets. It's about what people mean when they say, "The market is crashing." Because that phrase conceals a misunderstanding, one that costs real money in real crises, and one that has cost real money in every crisis going back nearly a century. Start here. October 1929. The Dow Jones Industrial Average begins what will become an 89% collapse over the next 3 years. Banks are failing. Unemployment is climbing toward 25%. Soup lines are forming in cities that had seemed, not 2 years earlier, like monuments to permanent prosperity. This is the worst economic event of the 20th century. And two companies, Homestake Mining and Dome Mines, the largest gold producers in the United States and Canada respectively, are doing something that makes no sense if you believe the phrase, "the market is crashing," describes what's actually happening. Homestake's shares are rising 474%. Dome Mines is rising 558%, while the Dow is losing nearly 3/4 of its value. Not just holding steady, not just preserving capital, rising. Both companies raised their dividends during the Great Depression. Homestakes went from $7 per share to $15. In a period of crashing markets, soaring unemployment, and soup lines, investors flooded into gold stocks during one of history's biggest deflations. This is where most people stop and file it under "gold works in a crisis." Understandable? Useful, even. But wrong in a way that costs the most money at exactly the wrong moment. Keep that in mind. We'll return to it. What 1929 is really showing is the first part of a pattern that will emerge in 4 distinct crashes over the next 100 years, each time with a different cast of assets. The pattern keeps circling back to one moment, the moment the distinction between a market and the market becomes the difference between rebuilding and not rebuilding. Watch for when that distinction appears, and in what form. Because in 1929, the people who understood that gold stocks were not simply assets in a crashing market. They were assets in a market that had become the alternative to a crashing market. Those people did not just survive the Depression. By 1940, Homestake shares had risen tenfold from their 1925 prices. The Dow, over the same 15 years, went nowhere. The people who did not understand this had savings in the bank, in bonds, in equities that looked diversified. Their portfolios fell in lockstep because they thought they owned different things. What they actually owned were different versions of the same exposure. That is the surface problem most financial media fixates on. You need to be in the right assets. And that is true. But it's the second question. The first question, the one that determines whether you ever get to the second, is, what do you actually own versus what do you think you own? These are often different answers. In 1929, most savers thought they owned stability. They owned correlation. Well, now move to October 1973. OPEC nations, in response to American support for Israel in the Yom Kippur War, cut oil production and placed an embargo on the United States. Within 4 months, the price of crude oil rises from roughly $3 a barrel to almost $12. The S&P 500 will fall 51% over the course of this bear market. GDP contracts. Unemployment climbs toward 9%. This is stagflation, the economic condition where prices rise while growth stalls, which mainstream economics had said couldn't happen. But in 1974, 7 of the 15 top companies on the Fortune 500 list are oil companies. Energy stocks are not crashing. They are the mechanism of the crash for everyone else. A worker paying to fill their car's gas tank in 1974 is transferring purchasing power to an energy company every single week. Those companies are not in a bear market. They are in a bull market funded by everyone else's bear market. This is not subtle. It is, with hindsight, obvious. And yet in 1973, the standard investment advice, be diversified, own a mix of equities, failed most middle-class savers who held what appeared to be a sensible, balanced portfolio. The energy exposure in a diversified index was not enough to offset the losses elsewhere because the weighting was wrong. You needed to be concentrated in the thing that was benefiting from the crisis, not merely present in it. Here is what that looked like for a specific household. A family in 1973 who had their savings in a broadly diversified equity fund would watch that fund fall 51% over the bear market. A family who happened to work in oil or held their savings in energy stocks not only didn't lose, they got raises. Their asset base expanded precisely because the crisis was, from their position, a supply squeeze on something they owned. Not a different story, the same story. Different seat in the same theater. The modern mirror is uncomfortable. Whenever energy prices spike sharply, and they do roughly once a decade, commodity producers and energy infrastructure companies reliably separate themselves from the broader market. Your brokerage app will show you red across most of your portfolio during those months. If you know where to look, it will also show you green. So now move forward to 2000 and the dot-com bust. The Nasdaq falls 78% from peak to trough, erasing more than $5 trillion in market value. 2000 through 2002 is the period that most investors remember as a unilateral collapse, and for technology portfolios, it was. But this is where the pattern gets strange in a way that actually changes what the pattern means. While the Nasdaq was in freefall, consumer staples returned 11.2% annualized. Utilities outperformed dramatically. Southern Company gaining that 132% mentioned at the start. Energy stocks surged as crude oil rallied from $20 to $35 per barrel. Mining companies posted returns of 200 to 500% as commodity cycles turned. Newmont Mining gained over 180% from 2001 through 2003. The S&P 500 fell 49%, but gold gained 15% over the same period. Notice something. This is a different crisis from 1929 and a different crisis from 1973. In the Depression, the beneficiaries were gold mining stocks. In the oil embargo, the beneficiaries were energy companies. In the dot-com bust, the beneficiaries were something else again. Boring, stable, dividend-paying companies that the market had been ignoring for years, while everyone was busy buying things with no revenue. The assets that win in a crash are not always the same assets. That is not the pattern. The pattern is something else. The pattern is that every market crash is a correction of a specific overvaluation, and that correction always produces a mirror image somewhere else in the market, a corresponding rise in whatever the overvalued thing had been crowding out. In 1929, frenzied speculation in equities had crowded out gold. The correction of that speculation sent money into gold. In 1973, energy dependence without ownership of energy assets had created a structural vulnerability. The correction of that vulnerability transferred wealth to energy owners. In 2000, speculative capital had flooded tech and ignored everything else for 5 years. The correction pulled capital back into everything it had left behind. The people who recovered fastest from the dot-com bust were not the ones who had predicted the crash. And they were the ones who owned the things that had been boring for so long that nobody had bothered to bid them up. The things with no momentum, no narrative, no magazine covers. The Southern companies, and the mining stocks, and the healthcare companies. They had been priced as if they would grow slowly forever. They had, because of that, enormous room to rise when capital needed somewhere to go. And here is the deeper problem, the one that neither the surface question nor the case studies fully explain yet. The question most investors ask before a crash is, what should I own? The question almost nobody asks is, what is my portfolio actually a bet on, structurally? Because every portfolio is a bet on something. A portfolio of tech stocks in 1999 is a bet that the narrative of the internet justifies the valuations. A broadly diversified equity portfolio in 1973 is a bet, implicitly, on cheap energy. A portfolio of government bonds in 1929 is a bet on the stability of the banking system that issues them. What makes a hidden bull market visible before the crash, not after, is not a prediction. It is a structural reading. The question is, what is currently being crowded out? What is being underpriced because capital is flowing somewhere else? What would rise if the direction of flow reversed? In every case we have looked at, the answer to that question was visible before the crash. Gold stocks in the late 1920s were cheap by the standards of actual earnings. Energy stocks were cheap before 1973. The world was entirely dependent on oil, and the companies that produced it were priced modestly. Boring utility and consumer staple companies were being sold in favor of internet stocks through the late 1990s. The crowding out was visible. The reversal, when it came, was not a mystery. It was a consequence. Now, here is the case that seems to break this entirely. 2008. The financial crisis that begins with the collapse of Lehman Brothers in September 2008 should, by this logic, have been a clear moment for gold. And gold had been rising since 2001, from below $300 per ounce to over $1,000 in March 2008. The setup looked correct. The pattern looked intact. And then gold falls. Not rises, falls. From March through October 2008, gold drops nearly 30%, while the financial system is visibly collapsing around it. This is the moment that broke the thesis, or appeared to. Because what was actually happening was this. When Lehman collapsed, every institution that had any exposure to the markets needed to raise cash immediately. Not next week. That afternoon. And gold is liquid. Treasuries are liquid. You sell what you can sell, not what you want to sell. The gold sell-off in 2008 was not a rejection of gold as a safe haven. It was a forced liquidation event. Institutions were not selling gold because they didn't trust it. They were selling gold because they trusted it more than everything else, and it was the one thing they could actually sell for cash. Or if you knew that, and a small number of people did, then gold falling in September 2008 was not a signal to exit. It was a signal that the liquidation was happening, which meant the recovery was coming. Gold ended the calendar. Year 2008 marginally above where it started. By 2011, it had reached $1,900 per ounce. But 2008 also produced a different kind of hidden bull market, one that does not fit neatly into any of the previous categories. A handful of investors, using instruments that had not existed in earlier crashes, were able to short the very assets that were collapsing. Credit default swaps on mortgage-backed securities, which most institutions did not understand well enough to price correctly. Michael Burry and a small group of others identified that the mortgage market was systematically underpricing risk, that the crowding out in this case was not a sector being ignored, but a risk being ignored. And they built positions designed to gain as the mispricing corrected. One fund personally earned $100 million. The broader trade that John Paulson ran earned $15 billion. Not the same as owning gold mining stocks during the Depression. Not the same as owning oil companies during the embargo. But structurally identical. They had found the thing that capital was ignoring, the risk that was being crowded out of the official picture, and they had owned that. If this is the kind of pattern that changes how you read a market, unlike and subscribe. The next piece on how people rebuilt after 2008, using the same logic this one just surfaced, is where this gets most useful. The before and the after turn out to be connected in ways that most financial histories skip past. Not all of these crises are equal in severity or duration. The dot-com bust was painful for technology investors, but left most people's daily lives largely intact. The Great Depression was a different order of magnitude. It restructured families, geographies, and careers for a generation. The tools that preserved wealth in one are not automatically the tools that preserve wealth in another. The gap between them is worth understanding. What the cases share is this. In every crash, people did rebuild. The Depression ended. The oil embargo ended. The dot-com bust ended. The 2008 crisis ended. In each case, the people who recovered fastest were not the ones who had the most cash when the bottom hit. They were the ones who had positioned themselves in the thing that the crash was correcting toward, knowingly or not. The baker in 1973, who happened to own a small stake in a local energy company, did not need to be a financial sophisticate. He just needed to own the thing that was rising while everything else fell. And some people, through luck or through reading, did exactly that. The question is whether it needs to be luck. The pattern says it does not. Every crash begins as a correction of a specific imbalance. The imbalance is almost always visible before the correction arrives. The asset that will rise is almost always the one that has been crowded out, underpriced, underowned, boring, narratively invisible. The crash does not create the winner. It reveals one that was already there, which brings the question back to wherever you are sitting right now. Look at the markets that have attracted enormous capital flows in the last several years. Look at what has been crowded out by that flow, what has been underpriced because everyone was looking somewhere else. The hidden bull market in the next crash is probably already there. It is probably cheap. It is probably the thing that feels least urgent to own. Of the assets you currently hold, every account, every fund, every position, how many of them are bets on the same underlying condition continuing? And if that condition reversed tomorrow, which one specifically would rise? Comment below with the sector or asset you think is most crowded out right now. Not the one you wish had more attention, but the one you genuinely think capital has been ignoring. Then keep watching, because the next video examines exactly what happened to the people who got the asset right, but the jurisdiction wrong, and why that distinction ended up mattering as much as the asset itself.